All right, we're a day after Father's Day, but at NDTV Profit, we're celebrating it today. So if you're tuning in, you're a father, happy Father's Day to you. And we're speaking to leading market voices through the day to help you understand how you should construct your portfolio. In fact, what they've learned from their fathers, what they're teaching their children. And in fact, our next guest is Samir Arora, who is the founder and fund manager at Helios Capital. Samir, thanks so much for joining us today.
Thank you very much. Thank you.
And I do want to ask you about some intergenerational portfolio building strategies that you might be able to talk about. But before we get to that, and it's a day, a start of the week where there's so much that is happening globally, so it would be wrong of me not to ask you about those things first. So let's get that out of the way, and then we'll get to advice. So you've seen everything that's happened over the weekend, crude oil prices since Friday going up. How much attention are you paying to that latest conflagration on geopolitics?
So the thing is that recent experience in terms of Ukraine, Russia war, and many other wars that have gone, including India, Pakistan, that right now the assumption is that, these wars last for a short period, although of course the Ukraine war is still going on. And therefore, I think the markets have, beyond falling of 1% here or there, have shrugged it, and so have I, on this hope that even Israel is saying that, this can last 10 days, and US says that I will try and resolve it after a few days. So there's no point in panicking now and then coming back 5 days later saying, okay, it is over. So let's now hope for the best that the response of Iran is there, but it doesn't look that it is going to really blow up into a, multi-country war and all that. So for now, we actually do ignore it.
Okay, so you're looking through it. But crude oil prices, they've been soft and hovering that near that $65 per barrel mark for Brent, talking about Brent. They've moved very suddenly up to 75. And I was looking at the RBI's projection or assumption as they talk about it for the inflation projection, it stands at $70, which is not too far away from that 75. Yeah. So from that perspective, even that's not too much of a concern. But what would cause you to worry if crude oil prices go to 80 or thereabouts?
No, not crude. I think if US gets directly involved, because the war, that's what I'm saying, it all depends on the response of the Iranian. Because if that response is sort of more aggressive, going into other countries, going into the places where US has forces, trying to stop the flow through that, the Hormuz Straits or whatever, all that is more serious and will require, or maybe not require, but will automatically lead to a more significant response from US. And then that makes it more serious. Right now, let's hope that the Iranians are also, in some sense, actually, they are doing it in a disciplined way by not trying to involve US in it. Because maybe they know that they can't handle a US response. So whatever it be, right now we'll have to see as it goes. And nothing is forever in these things, but for now, let's just
those are some words that I didn't expect to hear, the way that you're describing Iran, but let's move on from that.
The point is, 3 days later, they'll say, this has been resolved and oil has fallen $10.
Yeah.
So what's the point? Let's just see whether it really looks something worth bothering about.
Let's see where it settles. So then let me ask you this. We've seen intermittent flows into Indian capital markets, and of course, not whole hog buying, right? And I'm talking about foreign institutional flows here.
Correct.
Do you see that holding off just a tad bit while there's so much uncertainty, and what are the implications for India's market?
It might be in the short term, but again, that's what I'm saying. In every aspect, you'll have to ignore the next few days, 5-10 days. But in general, the outflow from US is very, very significant because the inflows into US since 2008 have been very, very significant. So the amount that the foreign investors have in US versus what the US investors have in non-US markets, that difference right now, something like $20 trillion. And this has happened because the US market has done very well since 2008-9, and the rest of the world has done poorly. And, you can see it also from the weightage of US in the MSCI World Index, which used to be in the 50s, and now is something like 65, 67, something like that. So that it is clear that the world does not want to have this higher weight, including us. We have a global fund in which up to Jan and we had maybe 74, 75% in US. Then we raised cash and now we have not gone back fully, but our plan would be to have only 50% in US. So that's a big difference. And I'm just one small example. And it's not only me, you can see it in flows, you can see it in ex-US world indexed ETFs have started raising a lot of money. This was an article either in Bloomberg or Wall Street Journal, because these are the only two primarily I read along with FT. But basically, the article was that these ETFs, which are ex-US world index trackers, have suddenly started getting lots of flow. So many people are thinking like me. It's not that I'm the only one. But these flows, if they go into non-US, then because the proportion is, let's say, 65 US currently and 35 non-US, and you move a few percent from US to non-US, then every half decent country will get some flows, and India is beyond that. So India should get proportionate to its size, reasonable flows. Another thing is, we really beyond a point don't need their flows right now.
Yeah.
We first need to stop their outflows.
Yeah.
So if that is there, and then a little bit of a flow is also there, and then the Indian guys have their own money.
On that point, do you think that the treasury yields as they stand right now is something that will cause them eventually to move? Or
That is part of the story.
incrementally?
That's all part of the story why people are buying gold. Even we in our new weightages want 9 to 10% just plain gold in it rather than having zero gold. And we have already got 6%. And otherwise, personally, I own a lot of gold for the last 2, 3 years. Not only me, now you saw there was an FT report, I think this weekend only, that the sovereign, not sovereign funds, basically the central banks, second largest weight after US dollar has become gold and has crossed euros. Of course, partly because of appreciation of gold, but also because they bought, I think, 100 tons per year or something for 3 consecutive years or something. So that is also clear. And it's all an anti-US, anti-dollar, anti-their deficit, anti-their issues. And also the fact that it was too much it had become on its own, not that somebody actively overweighted it maybe, but that the index rates became very high because of their continued outperformance for whatever, 15, 20 years.
Okay. Samir, focusing specifically on Indian equities and the valuation earnings story, do you think that it's comfortable right now? What is your base case assumption? Has that changed after you saw the 50 basis point cut? Because obviously, it'll take a couple of quarters for that to flow through.
Correct. So it is not that you can have a runaway rally. Our first idea is that you should stop falling because of flows, but you can't have a 20% rally because of flows. So I would think that in the next 9, 12 months, if you can be up 10%, it'll be great. And then by that time, hopefully some earnings improve on consumer side, maybe on IT side. And it's not only being driven by financials and some very select sectors. So right now, we are not saying it's some massive run, but it can be held well. And you need periods of this consolidation, you want to call it, or whatever you call it. But basically, it's not a one-way thing, even if there are flows from everywhere.
Okay. And if there are immediate reactions in certain pockets, you would use them as opportunities to buy and build positions?
So we have been doing that in all our funds. We are in our long-only funds here, offshore India long-only fund and Indian mutual funds and everything else. All are 98% invested, maybe.
Okay. Let's turn to building intergenerational wealth in portfolios. And ultimately, and I know that you spoke about gold, but a lot of people are talking about how equity should be bought. Did you get advice from your dad as to how to invest? And
so, unfortunately, I was born and raised, or not unfortunately, I'm an old generation guy. So my father also passed away early in 1988. At that time, there was no money to talk about investment advice. The only money you'll have is in PF, not me, my dad. And nobody was buying houses when you start working. You will buy a house when you retire. So after he retired, I was his co-guarantor, and we took a 50,000 rupee loan from HDFC, and then a top-up loan of 15,000 rupees. And I went to US. The point is, in those days, there were no saving avenues, but more than that, if you were in a normal job or a government job, You are not talking about how you will invest. So my advice is, indirectly you can say, although he may have given me in different way, is that initially you invest in your studies. I have reached now where very, very different only because of studies. And for that, you have to give credit to my family and particularly my dad, even my mom. But if you want to really change if you're already a rich guy, okay, give some advice, start saving from 20th when you are 20 years old and all that, which is complete nonsense for 98% of India. First is build your career, invest in your career, and then, and don't at 20 years say, oh, if I save for 40 years, then I'll be having retirement. Nobody thinks about retirement when you are starting out. So I think this Twitter and social media has got it completely wrong.
Okay. When you're buying equities, though, a lot of people tend to, Samir, focus on the quick gains. And while there are advantages, sometimes you might just actually hit the bullseye. In your opinion, does that happen too less of the time?
So first thing is that quick gains actually in theory hurt the young guys, because let's say in theory you are investing, and we say of course that you do SIP for 30 years, 20 years, whatever number of years, and if the market goes up early, because it's very unlikely that you're going to make money independent of the market going up in the early years. So if the market goes up a lot, okay, so you invested some say 10,000 rupees per month for 5, 10 months, 1 year, and the suddenly market went up 20%, 30%, and therefore that 2 lakh or 1 lakh rupees that you invested went up a lot. But now at those new prices, you have to invest for the next whatever number of years and so on and so forth. So in that sense, for the completely long-term guy, it actually in theory is better that the market does not go up a lot in his initial years. But of course, on the other side are people who are using that market to now exit, to now withdraw, because now their retirement is close, because they invested 20 years ago and they want the market to be high. So we are not saying that the market should remain low just because some new SIP guys will get, but they can easily formally, on paper, rationalize and justify that they should not feel bad. The guys who are retiring may feel bad, and therefore it should not affect their morale or their savings plan or their SIP plan,
Yeah.
because actually they should know that it is actually helping them.
Yeah. Samir, a lot of people talk about on Mother's Day what you should do for your mom. On Father's Day, often the talk is about responsibilities and what the dad needs to do. Uh, is there any advice that you would have to families and to fathers themselves on how to have a little fun?
So fun means, for example, my daughter, she lives in London, and because I'm going there tomorrow, day after. So I said, what have you bought for me? She said, no, no, we'll buy together because I don't know what to buy. So for me, getting a small gift is the highlight of my life. That's some good thing I will get on this Saturday. But then in general, the thing is that the best thing is that you are a father, so you don't need more than that. I think the best thing is first having a girl, second is maybe a boy, and third is maybe having both. But if you are a father, you've already gone ahead in life. It's the same way when people talk about, invest an SIP for 30 years and you'll make a lot of money and you'll be happy. The point is, if you can actually do an SIP for 30 years, you've already won. It doesn't matter what the amount is. You were able to hold on to this plan. That means you didn't lose your job, you didn't fall sick, you didn't have another emergency, things like that. So that itself is a great thing at any point in life, to be able to hold on to a plan that you make X number of years ago. So being a father is itself a big joy. And then, of course, you can have more fun. And A and B, don't spoil them beyond a point. I don't like that a 20-year-old is traveling in business class, for example. That's the only
Yeah.
thing I can see. I don't like a 20-year-old saying, I run my dad's family office.
Yeah.
And it first work somewhere, even if it's your dad's job, company, even if you know that in the end you don't want to do it, but you have to first do something else. And then slowly you'll come back, even if you're not doing his job, you'll use his money and you can be a family
Yeah.
office manager, but not on day one.
Yeah.
And not traveling business class on day one, I think, is my easy visual test.
All right, Samir, pleasure is always speaking with you. Thanks so
Thank
much
you.
for taking the time.
Thank you.